Will Bitcoin really break $100,000 before the year ends? And can Ethereum explode to $9,000 by January? According to Tom Lee, the answer is yes. Even after one of the most violent sell-offs in crypto history, even after a liquidation event that wiped out almost 2 million traders in a single day, Tom Lee says the real story is not the crash, it's what comes next. He argues that the old 4-year cycle is gone, the indicators everyone swore by no longer mean anything, and we are now living inside a new 5-year supercycle that is compressing years of market action into months. In his latest interviews, Tom Lee explains why he thinks 2024 and 2025 were only the warm-up act. He breaks down why Bitcoin's path to a new all-time high is still intact, why the October crash was a glitch-driven anomaly rather than a true reversal, and why Ethereum is setting up for a recovery move so aggressive it could redefine the entire market. In this video, I'm going to break down Tom Lee's newest predictions, the mechanics behind the crypto crash, why the divergence from equities makes no sense, and why he believes 2026 could be one of the biggest years in crypto history. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's begin.
We're almost through this year, and I'd say looking back, this was 5 years of history compressed into 1 year, because we had a major bear market, the biggest tariff hikes ever, and that, of course, killed any hope of any 7,000 in the first half. But miraculously, stocks went into a waterfall decline and recovered every single point of that decline symmetrically. So it really speaks to the resilience. But I guess as we're thinking about next year, I bet you it's going to be very similar in the sense that we'll get a policy shock, maybe whether it's monetary or from the administration, it could lead to a big drawdown of 20% again. But it's a replay of this year. And maybe we've now had 3 20% bear markets in 5 years. I mean, that's a lot of history compressed into a 5-year period. Crypto had been a leading indicator for actually most of the last 5 years. But on October 10th, crypto had what I would call Armageddon. You know, a flash event, but it led to a liquidation that was never seen in the 15 years history of Bitcoin. You know, about a third of the market makers went out of business that day. Almost 2 million accounts went to zero. And it was because of a pricing error, what I would call a glitch, you know, it led to what they call auto-deleveraging.
You've definitely made that case that it definitely seems as if there was something in the kind of market maker functioning that got fouled. Now, that being said, the reason you can have all those accounts auto-liquidated is because there were that many accounts with that much leverage that got Bitcoin up to where it was above 120. Right? I mean, so it's not as if it happened in a vacuum.
So if, in a way, it means crypto represents really a very precise measurement of risk appetite, because there's so much more leverage, and that got wiped out. That last time it happened in 2022, it took 8 weeks before people sort of touch their toes back in. I think that's where we are. We're near a bottom, but now I don't think crypto leads. Crypto is lagging because it's really the AI that's going to be leading.
Okay, so basically that is kind of sidelined the idea of what, Bitcoin 150, 150,000 you were thinking before?
Well, I think it's still very likely that Bitcoin's going to be above 100,000 before year end, and maybe even above one to a new high. So Bitcoin makes its moves in 10 days in every year. I think some of those best days are still going to happen before year end.
What we just lived through was not a normal year. It was an entire cycle compressed into a single burst of volatility. He describes the past 12 months as 5 years of market history squeezed together. We saw a deep bear market and the most aggressive tariff hikes on record. That combination crushed any realistic chance of seeing 7,000 on equity benchmarks during the first half of the year. Despite that, the market did something almost no one expected. Stocks fell into a waterfall decline and then recovered every point of the drop in almost perfect symmetry. Tom Lee calls this proof of resilience. Investors were shocked by the speed of the collapse, but they were even more surprised by how quickly the market erased the damage. That sets the foundation for what he thinks comes next. He believes the playbook for the coming year may look familiar. Policy shocks may strike again, and they may trigger another drawdown near 20%. Even so, he says that would only repeat the pattern we have already seen. In his view, we are living inside a new 5-year rhythm. 3 separate 20% bear markets have taken place in only 5 years. That pace signals a structural shift in how markets process risk. The crypto market sits inside the same environment. When Bitcoin fell sharply and the Nasdaq tried to follow it lower, fear rose fast. The market watched the October crash unfold and did not know whether it would spread into a deeper collapse. Tom Lee believes the event was violent but temporary. He points to the stabilization that followed as a sign that investors absorbed the shock and began resetting expectations. Next up, we will dive into how the crypto crash unfolded and why Tom Lee says the setup remains bullish for the long term.
Crypto has declines, and we're not necessarily in a bear market, and it feels terrible. In fact, that's what you have to be mindful of, is that it's a hyper volatile space, so it feels terrible now. But just like in 2024, crypto felt terrible for many months, and then we've had these big moves.
Yeah, you have the meltdown, then you have the melt up. Volatility works in both directions. Before I let you go, any price targets for ETH?
Yeah, I think, in the near term, there is downside, maybe to 2,500, but that's minor compared to the upside of trying to discount a super cycle. So we think ETH can be 7,000, 9,000 by the end of January, and that's a huge recovery move, but that's also pretty typical of what could happen in the fourth quarter.
Tom Lee describes what happened in early October as a true shock. Crypto had been acting as a leading indicator for nearly 5 years, often moving before equities and signaling shifts in risk appetite. But on October 10th, something different happened. Instead of a normal sell-off, the market experienced what he bluntly calls Armageddon. A pricing error triggered a cascade that liquidated almost 2 million traders. Roughly a third of all market makers vanished during the event. It was the largest single day of forced liquidations in the entire history of Bitcoin. This was not caused by fear or macro changes. It was the result of a glitch that set off auto liquidations at a scale no one had seen before. Tom Lee explains that the damage felt even worse because leverage had built up across the entire ecosystem. Traders had pushed Bitcoin to new levels during the previous months, and that leverage made the market extremely fragile. When the pricing error hit, the system unwound instantly. He compares the aftermath to 2022, when a major washout took 8 weeks before participants felt comfortable stepping in again. His view is that we are in the same zone now. Most of the forced sellers have already been removed. What remains is a market that is no longer driven by excess leverage. He also believes something important has changed. Crypto no longer sits at the front of the risk curve at this moment. Artificial intelligence stocks have taken that position. For now, Bitcoin and Ethereum are lagging. He stresses that this lag does not signal weakness. It only means the market is healing. Next up, we will look at why Tom Lee thinks Bitcoin can still break $100,000 and why Ethereum could become the backbone of Wall Street's future systems. Before that, if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in.
What is Bitcoin? I think everyone really accepts it as it's a store of value, a really good way to store value, and that's accepted today. In fact, someone might say that's like a Lindy effect, that people believe that. When we first started writing about Bitcoin in 2017, and digital gold was one way to sort of argue Bitcoin's value, it was not accepted because many people said, well, come on, I mean, it's just code. I mean, how can code store value? Or why can't there be 100 Bitcoins? Or look, I could create a new Bitcoin tomorrow, or I could fork Bitcoin and create a new Bitcoin, or I can't buy, I remember one client saying they couldn't buy a bottle of water with Bitcoin, so how could it even be valuable? So, but of course, all those arguments fell away. And now we have digital gold, Bitcoin, store of value. Even as gold gets tokenized, which I think will compete with Bitcoin to an extent, You still have Bitcoin, which is a really good way to store and transfer value. But Wall Street is also understanding there are a lot of virtues to a blockchain, and it's the ability to not only store value, but to store information and to actually transact and conduct and actually re-architect almost everything that Wall Street does. But they need a smart contract platform. And so that's where all these other L1s start to become a lot more important to Wall Street's future. Because if the big banks, the blue chips, build stable coins, and they're going to tokenize stocks and let stocks trade 24/7, and then innovate that too, which I discussed at the Cantor, which is like things like factorize a stock. So just like in the bond market where you can factor a bond, we can factor Tesla so that you're only buying the implied future value of Optimus Prime. So instead of asking Tesla to make itself a tracking stock, you can synthetically create that on the blockchain. So you can't really do that on Bitcoin. So you have to build it on a smart contract, L1 or L2. And the reason I think Ethereum is going to be one of the leading platforms is, number one, its sheer size. It is by far much bigger than the number 2 or number 3 L1s. It has a huge and growing developer community that is really dedicated, and it's global. So I think it's a true, robust community with actual known values. And it's a neutral blockchain with 100% uptime. So I think that this becomes one place where it's going to be easier for people to create innovative products.
Tom Lee moves from the crash itself to the deeper question that shapes every long-term prediction. What is Bitcoin now, and what role will Ethereum play as the financial world modernizes? He starts by acknowledging that something fundamental has changed. Bitcoin is no longer an experiment. It is accepted across markets as a store of value. The arguments that dominated the early years have disappeared. People once questioned how code could hold value, how supply could remain limited, or why a digital asset that could not buy a bottle of water had any purpose. Those objections have faded. The market now treats Bitcoin as digital gold, a tool to store and transfer wealth with reliability. From there, he highlights a shift on Wall Street. Major firms are beginning to understand the power of blockchain systems. They see that blockchains can store value and information and facilitate transactions without friction. They also realize something else. If they want to tokenize assets, run stablecoin systems, or trade equities 24 hours a day, they need a smart contract platform. That is where Ethereum becomes essential. Bitcoin cannot provide the programmable foundation needed for synthetic assets, automated settlement, or the creation of new financial products. Ethereum can. He points out that Ethereum has scale, a global developer base, a neutral structure, and uninterrupted uptime. These traits make it the strongest candidate for Wall Street's next generation of infrastructure. When banks begin issuing their own stablecoins or tokenizing stocks, they will require a network that can support both speed and creativity. Ethereum offers that environment. This forms the basis for Tom Lee's higher targets. The value grows as the use cases expand. The market has not fully priced that in yet. Next up, we will examine why Ethereum's volatility signals opportunity and how forced selling may be creating a major setup for 2025 and 2026.
Ethereum and Bitcoin are public tokens. And so their price isn't going to be purely anchored on fundamentals. They're going to be reflecting investors' perceptions, because both Bitcoin and Ethereum are not mature platforms. Their best utility and growth and innovation are in the years ahead, right? So we're 10 years in, but there's more growth in the future. The percentage of market share of crypto of total assets is so small that we know that mathematically that's true. Whenever when you have something that has a hyper growth on ramp, and you're discounting the future, it's going to be very volatile. So does Ethereum's price going from 4,800 to 2,800, I mean, that is a staggering decline, but that probably is a minor change in 2030 fundamentals that is being priced and repriced by investors, and that's why there's hyper volatility. It's one reason why BitMine ended up engaging Tom DeMark as a strategic advisor, because he is the king of sort of price discovery. You know, he is the father of systematic timing. And in our conversations, when he looks at Ethereum, he sees what looks like engineered or systematic liquidation taking place. So there is someone that is in crypto, we know it's, you know, market makers play a big role, but there's someone that is probably capital constrained and is therefore bleeding or having to sell reflexively as price falls. That process is painful, but in his sort of rough timing range, his downside target, and you know, we talked about this a few weeks ago, was 2,500 for ETH. So I think we're so close to that. It would be ideal actually for us to actually bleed to that level, because then that is creating what he calls a buy setup. You know, a bottom in prices for him is when the last seller has sold, so that a stock or crypto no longer falls on bad news. I mean, that's what he thinks makes a bottom. So it would, I think, be a better situation to see crypto prices bleed lower to 2,500. But it could reverse at any time, I mean, because markets don't have to do what ends up being an ideal scenario.
Tom Lee shifts the focus to Ethereum and explains why the recent decline, although painful, is not a sign of collapse. He starts by reminding people that both Bitcoin and Ethereum exist as public tokens. Their prices move according to investor expectations rather than mature fundamentals. These assets still sit early in their development timelines. Their future utility is much larger than their present usage, and that creates extreme sensitivity to every piece of information. This is why Ethereum can fall from 4,800 to 2,800 in a way that looks staggering, but Tom Lee argues the underlying fundamentals for 2030 barely moved. Investors are constantly repricing the future, and that repricing can swing violently in both directions. He then brings up the work of Tom DeMar, who he calls one of the best in systematic timing. According to DeMar's analysis, Ethereum's recent pattern resembles engineered liquidation. Someone in the ecosystem appears to be capital constrained and forced to sell as the price drifts lower. This is not organic selling, it is mechanical. DeMar sees this type of pattern as a sign that the market is hunting for its final seller. His downside estimate sits near 2,500. Tom Lee says being close to that range is actually ideal. When a market stops falling on bad news, that is a true bottom. It means there are no forced sellers left. He stresses that a brief bleed toward 2,500 would increase the probability of a powerful rebound. Even if the price reverses earlier, the setup still points toward a bullish path. The structural forces driving Ethereum remain intact. Developer activity continues to expand, network upgrades improve capacity, and Wall Street demand for tokenization grows each quarter. Next up, we will look at why crypto's divergence from equities confused investors and why Tom Lee believes the leakage is almost finished.
I mean, I'd say if someone wanted to say, why did crypto diverge from equities?
Yeah.
That's, I think, a big role, because there in the past 6 weeks, nothing has actually fundamentally explained why crypto should be underperforming risk assets. Because the S&P, of course, has had a drawdown, but the S&P continued to rise for another 20 days. The S&P didn't peak till the 29th. So that divergence has to reflect either a change in how market function in crypto, or was there an existential new risk? I mean, the only new existential risk would be like if quantum innovations came along, but there hasn't been that. So,
You think it's existential or just idiosyncratic? I mean, nothing seems existential here to me.
Well, I mean, Chris, the one thing that I would say that maybe isn't reflected in price is the number of account holders that got wiped out on October 10th. And I think that's, and we may not even hear from them because, they've been liquidated. To me, that's probably, now that could be someone's simply saying there was just too much leverage. That's why leverage is hitting crypto harder. I mean, that's a possible explanation. But to me, again, especially working with DeMark team, I think that there is something that is causing a lot continued leaking, but we're close to the end of that leaking.
Tom Lee closes this sequence by addressing the question that has bothered investors for weeks. Why did crypto fall while equities kept climbing? He notes that during the recent period, nothing fundamental explained the weakness in Bitcoin and Ethereum. The S&P index did have a minor drawdown, but it kept rising for nearly 3 more weeks before topping out. Crypto, however, sank far deeper and far faster. That disconnect made people search for reasons involving new structural threats. Some even speculated about exotic risks, such as quantum breakthroughs. Tom Lee dismisses those ideas completely. He says there has been no existential development that would justify a structural divergence. The explanation is simpler and rooted in what happened on October 10th. He points out that millions of accounts were wiped out during the liquidation wave. Many of those traders are invisible now because they were removed from the market. Their forced selling continued to ripple through the ecosystem. When a large block of traders disappears, liquidity drains. Market makers also suffered heavy damage that day. When they step back to rebuild their balance sheets, markets lose stability. That creates the leaking effect Tom Lee describes, where prices drift lower even without new catalysts. Tom Lee also mentions that some analysts attribute the weakness to leverage, which is possible, but he leans more toward DeMar's view. He believes the forced selling has been the primary source of pressure. The important part is that he thinks the process is nearly finished. Once the final seller is gone, the market stops reacting to bad news. That is the moment the next cycle begins. He expects that inflection point to arrive soon. This brings us to Tom Lee's bigger takeaway. The long-term uptrend remains strong, and the new 5-year cycle he describes points to 2026 as a potential breakout year for crypto. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.